This is Horizon's Middle East and Africa, our top stories this morning. Asian equities climb while the dollar and treasuries remain steady as investors assess comments from the Fed chair sowing doubt over a rate cut next month. President-elect Donald Trump rules out giving a post to JPMorgan's Jamie Dimon in his second-term administration while picking vaccine skeptic Robert F. Kennedy for health secretary. And we hear from Zimbabwe's finance minister, who says his country's economic fortunes are looking up despite having to contend with a crippling drought and a debt restructuring program. Good morning to you. It has just gone 8 a.m. across the Emirates, 6 a.m. here in South Africa, where I am. I'm Jennifer Zabasaja in Johannesburg. Happy Friday to you, Paul.
Indeed, I'm Paul Allen in Sydney. It's just gone 3 p.m. Friday afternoon here. Welcome to Horizons Middle East and Africa. Let's take a look at the market action this Friday afternoon. It's kind of mixed across the board. The MSCI Asia Pacific Index now better by about 0.4%. We're seeing a little weakness in mainland China, but elsewhere, most of the major indexes in positive territory. The Nikkei pushing ahead by about 0.8%. Got S&P E-mini futures, though, looking a little bit softer heading into the final day of trade in the US. And we had a lot of data out of the US as well. PPI index rose. Initial jobless claims dropped to the lowest since May last week. So major markets there retreated, and it looks like we're setting up for a little bit of selling today as well. Basically, data showing, Jen, that the US economy is very, very strong. And we heard from Jay Powell earlier saying, look, if the data lets us go slow, might be the thing to do.
Yeah, that's exactly what we're interpreting today, Paul. Listen, as you mentioned there, Fed Chair Jay Powell says the recent performance of the U.S. economy has been good, giving central bankers room to lower interest rates at a careful pace.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
Well, let's bring in Eugenia Victorino, now head of Asia strategy at SEB. And Eugenia, I want to pick up there on those remarks from Jay Powell. We've got a lot of traders really interpreting that as a little bit on the hawkish side. I mean, if we take a look at the latest market expectations, we've got now traders seeing less than 25 basis points of easing from the Fed over the next 2 meetings. So are we in a higher for longer environment now?
Indeed. So actually, the not in a hurry was actually a prompt for the traders to even lower their expectations for a December cut. But at this point, he's saying it not in a hurry, but that doesn't mean it's a signal for a hike. So we are still seeing room for them to continue the monetary easing, just not as expected. However, at this point, when you're looking at the terminal rate that the market is pricing in, I don't really see the room for further fading off of expectations from here. We're very close to how much we can really fade from the rate expectations. Because at this point, market is so focused on the inflationary risks of changes in policy. If anything, if you have a change in fiscal policy, that's going to have an impact on 2026 inflation rather than 2025. So that still keeps some space for the Fed to keep cutting from here.
Eugenia, what does that mean then for equities? Let's start in the U.S. Paul was mentioning the mixed picture that we're seeing right now, but U.S. equities have pulled back a bit from what we saw from the post-election surge. What does that mean then?
Well, I would think that the post-election surge has come to some resistance, but I wouldn't exactly cancel it out. Historically speaking, the equity rally would continue at least through the inauguration in January. So unless you have an actual change in fiscal policy or any change in the tariffs, there should be very little to hamper the risk sentiment, at least as far as U.S. equities go. But it's not necessarily the case for other markets, because as we had seen U.S. equities gain then the equity market in Asia had really been struggling, at least after the US elections.
Well, if the campaign rhetoric's anything to go by, we likely will see some quite aggressive fiscal stimulus in the US in 2025, which I guess would give the Fed even less cause to reduce rates quickly. Do you see that perhaps we're setting the scene here for a showdown between President-elect Trump and the Fed Chair Jay Powell heading into 2025? And what are the risks you see around that?
I wouldn't really say that the market should be preparing for a showdown, because after all, Fed Chair Jay Powell did cut interest rates 75 basis points already, so he is on an easing path. It would be a showdown if he were to start communicating to the market that he's willing to reinitiate a hiking cycle. So at this point, it's still an easing bias. It's just not as fast as the market had initially expected.
What about a showdown, Eugenia, when it comes to China? There is all this talk, of course, about a potential for an expansion of the trade war. Is there anything there that you're expecting?
Well, at this point, the market or even Chinese policymakers are already expecting that the trade war would intensify starting 2025. But the difference here is that nobody is expecting that Trump would go soft on China. Definitely, Beijing is not expecting a kinder U.S. policy on China, and they have been preparing for it. At this point, I think it is the other economies, the other trading partners of the U.S. that had stepped in to fill in the gap that the Chinese exporters had left behind since 2018. They are not prepared for a higher tariff. But China, they are prepared to come up. I'm not saying it's not going to hurt for Chinese exporters, but they're more prepared this time.
Well, a lot of the focus has been on China in this respect, but if we take a look at some of the other big Asian economies like Japan, South Korea, they also run trade surpluses with the US. Korean stocks in particular are looking reasonably well valued at the moment, but do you buy in that kind of environment, or do you just sit back and wait and see what happens?
It really depends on the timing, because it depends on which economy will be facing the tariffs. But at this point, I would say the easiest negotiation to tackle first would be the USMCA, or the one with Canada and Mexico, because it was Mexico that had really seen its trade surplus widening much faster than any other country. Meanwhile, I would also be looking at the trade surplus of Taiwan, Korea as well, but Japan not really. But at this point, the Japanese yen is already weak, so it's very difficult to see further weakness.
Really? I mean, Eugenia, that's surprising, especially considering dollar strength that we've been watching over the past few days. You don't anticipate any further weakness in Japan?
Well, definitely the dollar strength is dominating. So unless you expect the 10-year yield to go to 5.5% in 6 months, in which case you would require a hike, then the peak in the dollar yields is likely quite near from here. And it's really the rate differential between the US and Japan that's driving the move in dollar yen. Now, if you think that the 10-year yield is not going to go towards 5% from here, then I don't think we should be looking at 165. But at 160, there's still room to go to 160 from here, but 165 is a bit of a stretch unless there is a real re-rating in the rate expectations for the US.
Eugenia, we've talked a little bit about the Fed. I just want to quickly get your thoughts on the Bank of Japan, because we had Japan GDP today. That kind of boosted the case for BOJ tightening, also boosted the case for the government to get busy with fiscal stimulus. What do you see happening next for the BOJ?
Well, I would expect that the current or the resumption of weakness in the yen is really putting on the pressure for the BOJ to deliver on the hike. Our expectation is that there should be an adjustment in the BOJ policy either in December or in January. But at this point, the growth backdrop is suggesting that there is room for them to start or to continue normalizing their policy. Having said that, we're not really expecting them to hike 50 basis points. So the real driver here is from the U.S. side, and that is not moving too much from here.
There's a lot to still pay close attention to. Eugenia Victorino, head of Asia strategy at.
I'll come to you.
Now, JPMorgan Chase CEO Jamie Dimon says he's expecting a deals boom under the second Trump presidency, with the new administration seen as more amenable to mergers. He spoke to Bloomberg.
Because they have the Senate, the House, and the presidency, they have far more ability to do things like that. I think last time around, President Trump had started by saying for every new regulation, 1 in, 2 out. And I think later on he said 1 in, 5 out. I think they're going to do some of that again. I think it will, the banking industry, whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit. And so and you could have kept the banks equally safe, but had them do more credit. And so, to just give you an example, the average bank in America, I think the number used to have $100 of deposits and $100 of loans, and now it's $100 of deposits and $65 of loans. And if that's what you want, if for some reason the regulators think they're geniuses and that's the best way to run the banking system, so be it. But I think they did a lot of things that ended in that answer, but they didn't know that was going to be the outcome. So, and I think you could talk to any industry, and they'll give you examples of regulations that could be reduced and make it easier for them to do business while keeping the country safe, while keeping the air clean, while making sure the EPA does its job, et cetera. So I applaud them. They should be looking at those things.
Do you think if there is, particularly in the banking sector, less regulation, that there will be an even steeper competition with banks getting back some of the business from private investment firms?
Probably, yeah. I mean, because if you look at, you're asking about private credit and private investment, which I'm not against, and it has grown very rapidly, and it's got pros and cons. I'm always in favor of competition, but part of the reason that they are dancing in the street, which they said publicly, they used to get mad at me, now they say, no, he's right, is half the capital. No social requirements, no AML, no BSA, no fiduciary, no reporting to the government, no insurance, no liquidity. Yeah, it's a huge disadvantage. So yeah, I think it'll make banks get back some of that business. I think it'll be more important to regional banks than to JPMorgan.
There's also a question, whether it's banking mergers and acquisitions or just more broadly, whether there's going to be a more amenable administration to tie-ups. Are you seeing from your conversations in the past 7 days with companies that they are looking to expand their M&A pipeline to start putting that together?
Yeah, so yeah, absolutely. I mean, a lot of M&A was stymied by the fact it's not just sometimes you can't get through the courts or something like that, but it takes 2 years. It takes 3 years. So make believe you're a bank, and we've seen this happen. And one of these deals actually took 3 years. It takes 3 years to get it done. So you've done a deal, it's binding, you haven't closed it, but now you've got to run the company. You can't get the synergies. You're going to be losing people. You want to start working a common culture and common technology. You can't do it. So yeah, a lot of companies are looking at, will be looking much more aggressive at acquisitions and deployment of capital, and they should.
JPMorgan CEO Jamie Dimon there speaking at the APEC CEO Summit. Still to come, President-elect Donald Trump ruled out giving a post to Jamie Dimon in his second-term administration. We'll get the latest on who is picked for the new administration next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, Donald Trump says there's no room for Jamie Dimon in his new administration after previously saying he may consider the JPMorgan CEO for Treasury Secretary. Dimon responded while speaking with us at the APEC CEO Summit in Peru.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years, and I'm not about ready to start.
Quite the comments there. And in a controversial pick, the U.S. president-elect has tapped Robert F. Kennedy Jr. to run the Department of Health and Human Services. For more, senior editor Bill Ferries is joining us now. So, Bill, I mean, again, another potential nomination that we're hearing, and it's getting reaction on both sides of the aisle. I mean, what do you make of some of these picks that we've gotten this week from the president-elect?
Well, first of all, the president-elect is moving very quickly to fill in almost all of the top key posts. But you're right. Some of the picks have definitely been unconventional, to say the least. Robert F. Kennedy as Secretary of Health and Human Services will be a big fight in the Senate, even with some doubts among Senate Republicans about whether he has the right background. He, of course, has questioned the efficacy of vaccines, particularly the COVID vaccine in 2021. He's also said he'd like to see fluoride removed from water. There's a lot of questions about whether he relies on scientific advice for his decision making. So I'd expect this to be a pretty controversial confirmation hearing, assuming it gets to that point. But it's in line with a number of controversial picks, including Pete Hegseth for Pentagon Secretary, Matt Gaetz for Attorney General, and other picks for the intelligence agencies as well. So the big question will be whether Republicans push back on any of these picks, because that would involve inviting a real line of fire online from the president, from people like Elon Musk, to any Republican who goes against the president's wishes.
Bill, we've also had some less controversial picks in terms of Marco Rubio being tapped as potentially the new Secretary of State, and we're still waiting to hear who Treasury Secretary might be. Can we anticipate maybe a more conservative pick in that regard? I mean, Jamie Dimon's already been ruled out.
Yeah, I think, the top two names we've really heard so far for Treasury Secretary include Howard Lutnick of Cantor Fitzgerald and Scott Bessent of Key Square Capital Management. Both have obviously considerable Wall Street experience. I do think the Treasury Secretary job is probably the preeminent post from President Trump's point of view. He's well aware he pays hourly attention to the stock market. He knows that a Treasury Secretary is basically a shadow Secretary of State to the world's the global financial community. So he's going to take a little more time with that. But I would expect, given the pace that we've seen so far and how he's filling out this cabinet, I wouldn't be surprised if we get a pick like that this week. Just a few hours ago at Mar-a-Lago, President-elect Trump said he would be making another big announcement in the coming day. So it's quite possible that Treasury is on that short list now.
All right, we shall see. Senior editor Bill Ferries, thank you. Still to come, Zimbabwe's economy expected to grow 2% despite a severe drought. We hear from the country's finance minister next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Zimbabwe's finance minister says the country's economic fortunes are looking up, despite having to contend with a crippling drought and a debt restructuring program. Mthuli Ncube spoke with me at the CEO Dialogue in Johannesburg about the country's currency regime.
Frankly, the fundamentals are strong. There's no reason why the currency shouldn't remain stable. The ZiG shouldn't remain stable. If you look at, for instance, just simple reserves argument, if you look at the quantum of reserves, this is about 13 billion ZiG worth of reserves. If you look at the ZiG in circulation, is 12 billion ZiG. I mean, where in the world do you find a country that has enough reserves to back its entire domestic currency in circulation? We have that in place. There's no reason for the currency to weaken. But we know why it weakens, because people take a position, a sentiment. There's also a history, there's also hysteresis, to use a complicated economics term. So really, but there's no reason. The fundamentals are strong. We have been very tough on the budget deficit front. In fact, as I speak, we expect our budget deficit to year end to be 1.4% of GDP. Show me many countries that are recording that level of budget deficit is so low, that's a mark of fiscal discipline. We have positive real interest rates, so we have tough monetary policy. We have a current account surplus. For the 6th year running, we'll have a current account surplus, which means that the external balances are not a risk to the currency. So the fundamentals are strong.
Why is there not the same adoption, though, as, say, the U.S. dollar? I mean, there's still a majority of Zimbabweans that are using the U.S. dollar versus the ZiG.
Look, we've allowed it. We have a multi-currency regime.
But doesn't that undermine the strength that the ZiG will eventually...
We are going into a very interesting argument, which is what's the impact of having strong currencies running alongside weaker currencies? Of course, it does then put pressure on the weaker currencies. You expect, it to be the case because agents tend to want to save in the stronger currency and spend in the weaker currency. That's normal behavior when you have two competing currencies of various strength. But our view has been that, look, there are key benefits from the multi-currency regime, that is de facto dual currency regime, and that because the dollar does allow investors to be able to use it for investment purposes, for savings purposes, preservation of value.
So you do not see a situation in which the ZiG becomes the sole currency for the country?
Oh, one day. What is
the timeline for that then?
Oh, they say that you can never.
What's your hope though? Because
policy on the hoof.
What's your hope though? Because Zimbabwe has tried to do this quite a few times, not successfully. The ZiG now having a few days of strength, but I mean, could it ever really become the sole currency?
Yes, one day it will.
When?
When the time is right. We have a roadmap for that. I cannot give you a timeline on that.
Give us a short, maybe in the near term, sort of what that goal is.
I cannot.
Okay, but you do see it happening.
Because you know why? Because it's easy for speculators to take positions and so forth. So we can never pronounce on the exact timing of that. But we have a roadmap. We've made it clear that one day it will become the sole currency. It is the domestic currency of the country. So why should it not be the sole currency, frankly?
Zimbabwe's Finance Minister Mthuli Ncube there. Let's take a look at how we're tracking on a few key commodities here. The oil price is one to watch. We're going to dig into that in a little while. Well, let's start with what we're seeing in terms of futures, though. Futures pointing a little bit down at the moment. It was a bit of a down day in the US, perhaps not surprisingly, considering some of the commentary we had from the Fed Chair Jay Powell. Really strong data out of the US, of course, and that means, well, maybe it's going to be a slower path on rate reductions. Jay Powell says that if the data lets us go slower, that seems like the right thing to do. We've got an oil price which is looking weaker as well. A whole heap of headwinds there, from peace in the Middle East to a very, very strong US dollar to the potential for more pumping from the US. We're going to get into that a little bit more later on as well. Coming up, those sovereign wealth funds in Qatar and Kuwait made key changes to their top staff. We'll discuss the latest next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Asian equities climb while the dollar and treasuries steady as investors assess comments from the Fed chair, sowing doubts over a rate cut next month. The normally quiet world of Middle Eastern sovereign wealth funds has been jolted by a series of changes this week. Look at what's driving the shift at the $4 trillion market. And JD.com's moderate revenue growth signals a cautious recovery in Chinese consumer spending. Alibaba also expected to report slower sales from its e-commerce platforms. Jen.
That's right. It has just gone 6:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg.
And I'm Paul Allen in Sydney, where it's just gone 3:30 Friday afternoon. Welcome to Horizons Middle East and Africa. Let's take a look at how markets are tracking at the moment. We're seeing some modest positivity here in the Asia Pacific. We've got the MSCI Asia Pacific better by 0.4%. Most of the major indexes doing pretty well. A little bit of weakness in mainland China. Here in Australia, better by 2/3% on the ASX. The Nikkei, the best performing index right now, better by almost 0.9%. We had a beat on third quarter Japan GDP a little bit earlier on. boosting the case for the BOJ to lift rates there. Not really supporting the yen, though, still very, very weak at 156.40. Perhaps more a function of dollar strength, however. We've seen yields gradually ticking up as well, but this has got a lot to do with what we've heard from Jay Powell. We've got a chart here on the Bloomberg terminal showing us what to expect in terms of the future path ahead for rate cuts. And look at that, 25 basis points now priced across the next two meetings. Chair Powell saying today, well, noting really the strength of the US economy. We had the PPI index rising, jobless claims falling to the lowest since May, and Jay Powell saying that, look, if the data is going to let us go slower, that does seem like the right thing to do. We've had a few traders comment that this looks moderately hawkish. Lindsay Piegza of Stifel, for example, saying we are on the verge of a pause. Jennifer.
That's right, Paul. Markets interpreting that. Let's turn, though, to the Middle East. The normally quiet world of Middle Eastern sovereign wealth funds was jolted by a series of changes to key players in the global deal-making space this week. Qatar named a new CEO for its $510 billion fund, while Kuwait is replacing the head of its $1 trillion state-backed investor. For more on this, let's bring in Bloomberg's Mideast Money managing editor, Advith Nair, who is joining us in Dubai. So, Advith, talk to us through this shakeup. Talk us through this shakeup and really what this could potentially mean for these sovereign wealth funds.
Thanks, Jennifer. So, as you said, yeah, the world of sovereign wealth funds normally quite quiet, but anything but quiet over the past some days. So we'll start with Qatar, which really kicked off this series of announcements. They have a new CEO, as you said, for their $510 billion wealth fund. This is at a key moment for the fund that is expected to receive billions more in gas revenues from the state of Qatar. The CEO, the incoming CEO, has extensive experience in the US. He helped establish their office there. And it's coming at a time when Donald Trump is set to take the presidency. So we will definitely be looking for shifts in allocations and so on. The KIA, of course, yesterday named a new MD of its $1 trillion wealth fund. It's the second largest wealth fund in the Middle East, the fifth largest in the world. For the KIA, ultimately, we don't expect strategy to change significantly. It is controlled by the finance minister. Allocations tend to be weighted towards the US. 50% of their assets are in the US, followed by the European Union and Britain. So that won't change materially, but still a pretty significant development.
So what are the implications of this going forward?
So for the wealth funds, it's an interesting question, right? So there's a lot of challenges for everyone to navigate. I mentioned the Trump presidency, but there is also the West's evolving relationship with Asia, increasingly competition between the Gulf hubs themselves. But with all of that, it's important to note that these entities in all control $4 trillion. They accounted for about 40% of the value of all deals done globally by sovereign wealth funds, which is significant. Pretty much everyone still sees them as bankers to the world. So they will continue to operate from a position of strength, but it will be an interesting few months ahead.
All right, thank you. Mideast Money managing editor Advith Nair there. Well, the IEA says global oil markets face a surplus of more than 1 million barrels a day next year as Chinese demand continues to falter.
Now we're seeing this slowdown, and it's not just the economy and the slowdown in the construction sector, but it's this transition to EVs, high-speed rail, and gas and trucking that is undermining Chinese oil demand growth. So we're seeing this continuing forward. We do expect growth in the medium term in China, but much weaker rates than we've seen in the past.
Well, let's discuss this further with Vandana Hari, founder at VANDA Insights. Vandana, thank you so much for joining us today there in Dubai. There are just so many headwinds for oil at the moment, notwithstanding President-elect Trump's plans to drill, baby, drill. We've seen Brent prices come off about 5% just since the election. Are you willing to put a floor on prices from here?
Yeah, morning, Paul. So there are uber bearish folks in the market. I'm certainly not in that camp. I see Brent slipping back towards 70. We are not too far from there. Perhaps testing that level and going into the 60s briefly. But Look, Paul, if you're talking broadly about 2025 average prices, my expectations would be Brent hovering around $70 a barrel, certainly not into the 60s and 50s. I am well aware that some analysts have called for prices to drop that low. There is still a lot of question marks on supply, a little bit on demand. So while the big picture is, yes, that demand has already turned sluggish this year and continued to do so next year, I think there's no doubt about that. But on the supply front, and especially with the IEA and OPEC reports and EIA as well this week, we see that there is a fair amount of disagreement on especially non-OPEC plus supply next year. So let's see. I'm not uber bearish.
Vandana, if this report did not make you uber bearish, then what insight did it give you then to potentially what we could see from oil markets in 2025?
Yeah, so Jennifer, let's keep in mind that the market has, for the past several months, actually shrugged off the very precise demand numbers, especially that have been coming out of, especially the IEA and OPEC, because of the major divergence. Now, this year, they are ending up diverging almost by 1 million barrels per day in terms of 2024 annual demand growth. The divergence is thankfully less as we look out into 2025. So we see the range somewhere between 1 million barrels per day on the low side for the IEA and 1.5 from OPEC. So at this point, the market has more or less formulated its outlook for 2025, which is that it is going to be more surplus as demand continues to slow further compared with this year, and as non-OPEC plus supply continues to come back, continues to boost supply. I think there's a little bit of a question mark on what OPEC plus does. So the IEA yesterday, for instance, said that it expects 1 million barrel per day excess supply in 2025. I don't think it's going to be that much. From our calculation, there's probably anywhere between 200 to 500,000 barrels per day. I think it will, we'll wait and watch what OPEC Plus does with the 2.2 million barrels per day of cuts that it has planned to unwind starting January. Again, on that, I think my base case is that it will go ahead and unwind those cuts. I think it's got very short runway ahead of it. The 8 members that are shouldering those cuts are probably going to start running out of patience if they haven't already done so.
Vandana, I wonder if you have any views specifically on the outlook for Chinese demand, because, of course, as the trade war picture becomes a little bit clearer with the US heading into 2025, it's not hard to imagine a scenario where we get more stimulus coming out of China. Do you have any expectations around that?
So, Paul, I have been bearish on Chinese demand pretty much since actually the middle of 2023. And I don't see that picture changing. Going into 25, we've had a spate of stimulus measures from Beijing, most of them monetary stimulus, a little bit of a fiscal stimulus. None of that has got the China watchers excited, understandably, because basically Beijing is not, all of those measures, it's not putting money into the pockets of the consumers, which is what observers say is needed really to pump prime that economy. So China, this year, we see demand probably flattish or very, very little growth, and the same story continuing into 2025. The headwinds for China and the structural challenges for the economy are huge. I don't see those changing in 2025. You mentioned tariffs. Yes, I think let's wait and see whether Trump actually imposes the kind of, hefty 60% tariffs, or it's just a negotiating tool, to start the bargaining process with Beijing. And yes, Beijing could come up with more stimulus measures. So at this point, I would say premature. I wouldn't advise anyone to majorly tweak their expectations for China, which is just basically sluggish, continuing sluggish oil demand growth going into 2025.
All right, we have to leave it there. Really appreciate your insights, though. Vandana Hari, founder at VANDA Insights there in Dubai for us. Great to have you on this morning. Now, coming up, the IMF and Democratic Republic of Congo agree on new loans worth close to $3 billion. We have the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasadja in Johannesburg. Now, the Democratic Republic of Congo is set to receive nearly $2.9 billion in financing over the next 3 years. That's after IMF staff agreed to support 2 new loan programs with the Central African nation. For more on this, let's bring in Bloomberg's Andira Oganga, who is joining us from Kigali. So, Andira, walk us through this new financing.
Jen, so they will receive 2 kitties. One is the extended credit facility, which gets about 1.77 billion, and it will go into several things. One, diversifying the economy. So Congo is one of the world's largest producer of copper and also the largest producer of cobalt, which is a critical mineral in the EV industry. And the country has found itself extremely reliant on its minerals, and prices in the global market fluctuate, which is not really good for their budgeting and planning. Some of this money will also go into job creation and also elevation of poverty. It's one of the richest countries in terms of its resources and mineral deposits, yet a large majority of the population live below the poverty line. There are also questions about governance and transparency, and this money will go into reforming the tax system so that there can be efficiency in tax collection and also some form of efficiency to weed out tax evasion and also tax exemptions. They'll also receive some money under RSF, which is about 1.1 billion shillings that goes into climate-linked initiatives. And DRC is the world's second largest home of big rainforests, so which is really efficient in absorption of greenhouse gases. This money will go into protecting these forest reserves and also building resilience towards climate-induced natural disasters. And this new program comes at a really critical time because for the first time in a really long time, DRC was able to complete an IMF program where they did 3 years and they were given $1.5 billion. And the IMF says that their performance from the previous program was generally positive.
So more broadly, how's the country's current outlook?
Well, that is a really interesting question. So the IMF says the outlook is generally favorable, but there are risks. One of those risks is the fighting in the eastern part of the country that has displaced nearly 6 million people, and about 27% of their revenue in the first quarter went to security-related expense. Then there's the other risk of inflation from volatility of prices of goods such as oil and also food prices. But in general, if you look at the economy last year, it grew by about 8.3%. They had $5.5 billion in terms of reserves that can cover at least 2 months of import. This year, they're projected to grow at 4.7% and average 4.8%, leading all the way to 2028. And this is if 1, they expand their major mines, and 2, work on diversifying their economy.
And Andira, I wonder, when you look at some of the other countries we cover that are under similar IMF programs, how does this one compare to others that we've been covering and that we've seen across the region and the continent?
Well, I think just going off what IMF said, DRC has come a really long way. They've had to make a couple of reviews and adhere to some of the conditionalities, including transparency, particularly in the mineral sector. The IMF has been always very consistent in saying they want transparency in the mines. If the government sells the mines, they want to know how much has been made. They want to know how much from their minerals go into their budgeting. And they were also keen in pushing them to renegotiate their contracts, particularly with countries like China that have huge stake in the mining industry in the country. So just going by IMF, they've performed really well, and DRC is a country with unique set of challenges. So bearing in mind that this is a country that has been having civil war for decades, sectors are not very vibrant and they're reliant on only one sector. Fair to say that based on the IMF projections that they've come a long way.
All right, Bloomberg's Andira Oganga, thank you. Still to come, JD.com's moderate revenue growth suggests a cautious recovery in Chinese consumer spending as China rolls out stimulus measures to boost its lackluster economic growth. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zapasaja in Johannesburg. Even as Donald Trump unveils more controversial cabinet picks, there's one name that still stands out. Elon Musk is set to lead a yet-to-be-created Department of Government Efficiency alongside Vivek Ramaswamy. Bloomberg Originals, though, has been looking into how Musk's new role may open up glaring conflicts of interest.
In a dramatic political comeback, Donald Trump will return to the White House. And if he's going to share the credit for his victory with anyone, it's this guy.
Where is he? Come on up here, Elon. Come here.
Elon Musk, known for selling cars, making rockets, became one of the biggest political donors in American history.
This is like a mutually beneficial business arrangement, right? Trump got money and got elected. Musk gets sway over the federal government.
This mutually beneficial arrangement includes a new role for Musk that raises a whole host of potential conflicts.
I think the funniest name is DOGE, the Doge, Department of Government Efficiency.
Musk wants the federal government to mostly get out of his way. Tesla is a electric car company, and it very much would like the federal government to approve its business in robotaxis, driverless cars.
While pushing for less federal oversight, Musk also stands to gain billions.
Elon Musk owns a major defense contractor. It's called SpaceX. The U.S. government is their most important client. He would like as many more contracts as possible and would like a president who would say, create a new Mars program and hire him to send the rockets up.
This is Trump 2.0. The sort of old rules of conflicts of interest may be out the window here.
And subscribers can see that report in full on the terminal or at Bloomberg.com. And it'll be on the Bloomberg Originals YouTube channel later on today. The Hong Kong markets are on their lunch break. JD.com trading 1.4% lower before the break. Alibaba also slightly in the red. JD.com's quarterly revenue rose 5.1%, a moderate expansion that suggests Chinese consumers are only cautiously spending again. For more on this, China correspondent Min Min Lo joins us. So, Min Min, what were the key takeaways for JD, and what does it tell us about the Chinese consumer?
Yeah, so the revenue came in pretty much in line with estimates, but we got a beat in the earnings before tax, which came in at about 15 billion yuan. Estimates was 13.7 billion yuan. It was a 17% growth year on year. Net income as well was up by 48%. So a pretty solid set of numbers here, perhaps bolstered by that longest ever period of that Double 11 sales that was at least about a week longer than the previous year. JD.com said that orders number during Singles Day was up by 3.8 times, and the number of shoppers up by 20% as well. But interesting that they still declined to provide that GMV sales number. That was something that many of these e-commerce platforms had stopped publishing a couple of years ago during the pandemic. And perhaps is that lack of transparency, or perhaps is that fear around the broader economy, and whether this is a one-off boost from the Singles Day sale that is still weighing on investors' sentiment here.
Min Min, there's a lot of focus on Alibaba reporting earnings later today. I mean, what's the expectation there?
Yeah, we'll also be watching Alibaba very closely for any sort of numbers that they can give us about the Singles Day promotion. There are some industry reports suggesting that Alibaba may be the bigger winner here compared to JD.com. And of course, the company, we know that it has been focusing more on this premiumization play, some of the VIP customers bringing in more online merchants. So investors will also be looking out for the impact of this new vendor service fee on revenue and how popular that new ad tool is as well. Revenue growth from Taobao and Tmall forecast to grow 1.5%, slower than the previous year's period of 4.2%. But again, it's not just pricing, it's also the logistical costs of carrying out all these refunds that is part and parcel of the online shopping experience, and that cost is also something that investors are worried about that could be weighing on earnings as well. And as you can see, the stock was down about 0.3% before the lunch break as we await the earnings report.
We were hearing from Vandana Hari a little bit earlier in the context of a conversation around oil, and she couldn't see any support for oil prices unless there was something meaningful from the Chinese government in terms of stimulus when it comes to consumers. Are we hearing similar sort of talk around Alibaba, JD.com and some of those other big retailers that without support from the government, it's going to be a hard road ahead?
Yeah, I think the concern here, as I said, the question is whether this is a one-off boost that we're getting from that longest ever promotional period that we're seeing on Singles Day, and whether we will see this consumption boost, the strong numbers we have seen this quarter, whether that we will see an early petering out if those support from the government doesn't come through, because we know that these e-commerce players, they're getting a big boost in home appliance sales, electronic sales because of that equipment upgrading program and the subsidies from there. So will the local governments continue to keep up with these consumption vouchers or subsidies? I think that's really key to maintain that momentum in this modest recovery in consumer spending.
Bloomberg China correspondent Minmin Lo. Minmin, thanks so much for your reporting and for joining us this morning. Now, let's take a quick check at where markets are before we head to the second hour of Horizons. As you can see, a bit of red on the screen right now. We're seeing U.S. equities in particular taking a bit of a breather since we saw that post-election rally. Downside for S&P and NASDAQ futures about 0.3 and 0.4%. We're also seeing at Eurostock 50 futures seeing a bit of downside. Potentially that continues going on, but we did hear from Fed Chair Jerome Powell on Thursday suggesting maybe a more cautious approach for the Federal Reserve. All right, we'll leave it here. That is the first hour of Horizons Middle East and Africa. Stick with us for the next hour. This is Horizons Middle East and Africa, our top stories this morning. Asian equities climb while the dollar and treasuries remain steady as investors assess comments from the Fed chair sowing doubt over a rate cut next month. Israeli ground forces are expanding their 6-week-old sweep of villages in southern Lebanon, while U.S.-led ceasefire plans remain in limbo. And as influential leaders are still gathered at the COP29 summit in Baku, Azerbaijan, we speak with South African Environment Minister Dion George on the push for climate finance. Good morning. I'm Jennifer Zabasaja in Johannesburg, where it has just gone at 7 a.m. Welcome to the second hour of Horizons Middle East and Africa. We made it through the week. It is Friday. Thanks so much for sticking with us. And if we take a look at markets, potentially they're taking a bit of a breather too on this Friday. If we take a look right now, if we first of all, starting with Asian equities, they are slightly firmer, which is a welcome change for Asian equities, especially after what we've seen over the past few weeks. We did get consumer retail sales out of China that beat expectations, potentially giving a boost to Chinese stocks. And then we will get Alibaba results later on today. Potentially that could add more fuel to that. U.S. equities taking a breather, as I mentioned, following that post-election rally. As you can see with S&P futures, they've dipped below that 6,000 print, and that came after we heard from Fed Chair Powell saying there is no rush to cut rates aggressively. That potentially then having an effect on dollar yen, slowly starting to soften a bit. We did hear from the finance minister and also from Ueda, who will give a press conference later today. The price action there suggesting potentially we'll see this be the print where it's at right now, 156.35. And of course, the Trump 2.0 trade is still the major driver for this currency pair. Finally, 10-year yield right now at 446.10. We did see, of course, some action after we got those comments from Fed Chair Powell. And those comments still reverberating across the markets today. As you can see on this terminal chart, right now the market's paring back their expectations for Fed cuts over the next few sessions. And what we have right now, the market now pricing less than 25 25 basis points of cuts across the next two meetings, pulling back what they had seen and suggested in the past. Perhaps then we see a cut in December, potentially a pause follows thereafter. But a lot of this action coming after we did hear from Fed Chair Jay Powell. And let's just stick on some of the comments we did hear from the Fed Chair. He did say this. He said the recent performance of the U.S. economy has been good, giving central bankers room to lower interest rates at a more careful pace.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
For more, let's bring in executive editor for Asian markets, Paul Dobson. So, Paul, what are you taking away from Powell's latest comments?
Hi, good morning. So I think that, the market at least is reading Powell's comments a little bit hawkish, the tone that he's chosen to adopt and that stance, not being in any hurry to cut interest rates, being careful and cautious and calibrating the approach right. So what we saw as a result of that is the market being a little bit more circumspect, as you were saying, about whether the Fed will move again in December and then how quickly it continues to cut after that. I think December is back to basically a toss-up in terms of market pricing now, so really data dependent. We'll see what we learn on the economy between now and the final Fed decision of the year. After that, the interpretation seems to be that the Fed is setting the stall out for the possibility that it skips some meetings in the cutting cycle, maybe as soon as January, seems to be the consensus from the analyst notes that I've been reading on the matter. And so we may see a slower pace of cuts through next year than had been previously priced into the market, and ultimately a higher sort of resting point for interest rates, depending on obviously what the data show us in the meantime.
Weighing on what the Fed was going to do next, though, Paul, at least over the past week or so, has been what do we see from Trump 2.0? Does that go away entirely, or how does that play into potentially the trajectory for the Fed over the next few months?
I think that the way that the Fed has been trying to communicate this is we can't do anything until we know what it looks like. So there's no point in getting ahead of ourselves or trying to second guess exactly what that policy could be. It's too uncertain at the moment, and and it can, as we know from Donald Trump, it can change on a whim as well. So so Powell and his colleagues have been pretty careful to say we will base our decisions on what's out there at the moment and not think too much about future projections. Markets, of course, don't work that way. They're already starting to price in the idea that the US will have a much more stimulative approach to fiscal policy starting from next year under a Trump regime, all things being equal, that being likely to be inflationary. So the market has been quicker to price in a sort of higher for longer or less cuts from the Fed path than the Fed itself would be likely to want to communicate at this point.
Seeing that hitting over markets across the board. Paul Dobson, executive editor for Asian Markets, thanks so much for joining us and for your insights this morning. Let's pivot to the Middle East. Israeli ground forces are expanding their 6-week-old sweep of villages in southern Lebanon, triggering new clashes with Hezbollah militants, while U.S.-led ceasefire plans still remain in limbo. Now, the advance comes alongside airstrikes against Hezbollah sites in Beirut, which has drawn criticism from the U.S. Let's get more from Bloomberg's executive editor for Middle East, North Africa, and Russia. That's Stuart Livingston Wallace. So, Stuart, what does this expansion of the ground war in Lebanon signal about the potential for a ceasefire? We've been talking about this for quite some time.
We have. And there seems to be a degree of optimism within certain camps, but the big bit that's missing here is Hezbollah. It's really not clear what their position is. So in the interim, what seems to be happening is that Israel feels it has some momentum, it has some clear objectives in terms of what it wants to achieve, particularly in southern Lebanon and, yes, up into the suburbs of southern Beirut. And it's just going to continue on that path until, basically, I think Trump comes into office. So I think over the next couple of months, we're going to see a continuation of this, absent some sort of concrete proposal that all sides can get behind. So really, it's about rooting out the military pockets that they have, the Hezbollah pockets they have around southern Lebanon, clearing that area and offering some safety to the north of Israel so that it can move those citizens back into that area. And we're talking about something in the order of 60,000 people.
Do we know, Stuart, what the sticking points are in actually reaching the ceasefire deal? I mean, is it really just hinging on when Trump will come into office, or are there other sticking points that we're potentially not factoring into the discussion here?
I mean, largely the details that we've seen seem to be mostly a retread of UN Resolution 1701, which dates back from 18 years. So the broad contours of that are effectively the demilitarization of the south of Lebanon up to the so-called Litani River. And then within that area, you would have some sort of international force, mostly UN-led, plus the Lebanese army. What seems to be different this time is that Israel is insisting that it has the right going forward that if the Lebanese army and the UN forces fail to act on intelligence given to them by Israel about Hezbollah activity in that area, Israel can unilaterally intervene at any given moment to protect its citizens. And I think that is going to be the hardest thing, or the hardest hurdle to get over in terms of getting that final deal.
Stuart, let's just finish on what we have seen from the president-elect Donald Trump. I mean, he's been appointing a number of names this week, and in particular, many people are focused on what this could potentially mean for the U.S.'s relationship with the Middle East. How are you reading into some of these names and potentially what that means for the next administration?
Yeah, I mean, I think that's quite right, that there is a strong Middle East influence here in terms of the names that we have seen, and certainly the names that we're seeing being proposed or talked about. So I think there's two main takeaways from that. Number one, Israel is clearly extremely happy about the transition into this new administration, because Trump has shown himself to be willing to do a lot of the things that Democrat administrations have not. So that's number one. Number two, I think he's probably going to bring in a lot of Iran hawks back into the administration and maybe move back towards that maximum pressure policy that we saw under his first administration. Now, that in turn is causing some worries within the Arab Gulf, because they, since that first administration, have taken a slightly different tact and re-established diplomatic relations with Iran. And I think they're very concerned that going too hard against Iran just risks rocking the boat right across the region again, particularly in the scenario where we find ourselves now, with multiple hot wars already underway right across the region.
All right, let's leave it there. Bloomberg's Stuart Livingston-Wallace. Stuart, thanks so much for your reporting. Thanks for joining us this morning, and as always. Now, still ahead, we talk markets with Chiedza Madzima, head of global operational risk research at BMI. But next, our interview with South Africa's environment minister about COP29 negotiations to finalize a funding deal. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasajja in Johannesburg. Now, influential leaders are still gathered at the COP29 summit in Baku, Azerbaijan, with the aim of finalizing a climate fund to help poorer countries combat climate change. Developing nations have set a target of $1.3 trillion in finance a year. Joining us now is Dion George, South African Environment Minister. He is in Cape Town with us. Minister, thank you so much for joining us. We mentioned that figure there. Is that climate request, though, is it feasible, considering what we've seen from developing nations? They've only hit their target of $100 billion in the last year or two. How do you get to this number?
Well, I think we've been talking about being ambitious. So if we're going to have ambitious targets, we need to be ambitious also on the money and the financial side. So yes, it is so that there was quite a lot of roundabout discussions on whether the $100 billion was paid or not paid. We don't think, from South Africa's side, we don't think that it's a useful conversation to keep having about the same thing, whether the money was paid or wasn't paid. The key thing is that if we're going to be serious about getting somewhere, we need to make sure there's enough money. There is enough money, It's just about the choices. So we set that objective of $1.3 trillion per annum. We think that it's very much doable, but of course it's going to require political will from the developed economy countries to actually pay that money. We do think it's possible. It will be hard, but we also think that there is room for a conversation on a climate financing model. Frankly, the model we have now is not working. It needs to change. So yes, we need to set the NCQG, the collective goals, of course, but that's only one piece of the conversation. Because South Africa is going to be the president of the G20 next year, and we've already started the conversation about the global financial architecture that's not working for the developing economy countries. So that's a broader conversation that's needed, and we think that it's a great opportunity now to start that conversation. Because it's ongoing, obviously, because we're going to head to COP30 next year, etc. So it's a never-ending conversation, but it's becoming more critical because obviously the impact of climate change on the world is being seen much more. It's been felt much more. So I think that anybody who's been a bit reticent about it is starting to realize that this is in fact a real existential crisis. And if we do nothing, we're going to have a really big problem on our hands. So, yeah.
When you talk about the developed nations that will contribute to this fund, is China a part of this? Because in the past, South Africa had taken a specific stance. At this point in time, does China make up part of the countries that contribute to this?
Well, that's also the big debate that is going on. Obviously, China's position is that it is a developing economy and it is not required to make a contribution on that particular item. The developing economy countries certainly believe that China should be contributing. And I think that that also is a bit of a standoff because it doesn't really take us forward, actually. So I think that the conversation needs to be more nuanced. It needs to be more about the model that will work for the world. That's what we need. So South Africa is a non-aligned country. We obviously speak to everybody, and we occupy a very interesting space in those debates because, as I said, we speak to everybody and we are on collegiate grounds with everyone. We are a member of BASIC, as you would know. So when I was at pre-COP, we did have quite a number of conversations as a BASIC group, and we'll have some more when I get to Baku. But I think the crucial thing is that where I think the argument comes in is that if you look at a model, you need to look at the components. So the basic component obviously is the NCQG. That would basically be a contribution by the developed economy countries, and that would obviously need to be divided on a needs basis and an outcomes basis amongst the developing economy countries. And then we need to start talking about the cost of capital. And that's the other component to this debate. And I think that's where the China conversation comes in. Because obviously there are many countries in Africa that are very heavily indebted, and so they are not going to be able to fund much because they don't have enough space on the balance sheet. South Africa is paying 1 billion rand a day on interest repayments. So our ability to borrow money is extremely constrained. So we do need to be very realistic about what is possible.
And nuanced, of course, Minister. I also want to ask you about what we've seen in geopolitics over the past few weeks, because surely that will have an impact on the discussions. We've seen the re-election of Donald Trump. In Germany and Europe, we have seen a number of shifts happening there. How could that potentially impact any sort of outcome that you get from COP?
Well, I've been pretty straightforward, I think, with the European Union and the USA and others, to say basically is we need to have those straightforward conversations. We're either going to get the money or we aren't. And if we're going to get the money, then it must get paid and it needs to be accounted for. There can be a standard, for example. So it's not hard to actually count whether it's been paid or not. So we have to decide that. If we're not going to get the money, then we need to know that as well, because then we can make the other plans that we need to make. So I think there's a bit more honesty required in the conversation. But I think that it is difficult, obviously, because we've seen the German government now change. I have been assured by the German delegation that nothing is going to change, their position doesn't change, and that they are part of Team Europe. So that seems to be the track that will be taken, but I'll see when we have the conversation. On the USA, that's going to be very interesting. I did actually ask before the elections, obviously nobody knew what the outcome was going to be, but I think we could read the tea leaves. So I did say, well, will the USA's position shift? I never got a response on that, because obviously the government has changed, and therefore something else might change. Obviously, Donald Trump did say previously that he would withdraw from the Paris Agreement. Now, that did not happen, but will it happen now? We don't know. So what America and China do matters enormously to everybody. But again, that's why the conversations are required. So the USA must decide what it wants to do. I know that the US president-elect had quite a lot on his mind in terms of his opinion on climate change. But we'll see whether the US has a new mandate now. So we'll find out very soon.
There's a lot of uncertainties, it seems, Minister. It will be fascinating to get your insights, though, when you return. Dion George, South African Environment Minister there in Cape Town with us. Thank you so much, Dion, for your time. Now, coming up, JPMorgan's Jamie Dimon sets his sights on M&A after Trump rules out appointing him to his cabinet. More from our interview with him next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. JPMorgan CEO Jamie Dimon says he's not bothered by Donald Trump's saying there's no room for him in his cabinet. Dimon spoke with Bloomberg surveillance anchor Lisa Abramovitz at the APEC CEO summit in Peru. He says he didn't want a government job anyway and sees the next administration facing a very tall order. Take a listen.
You had a big sea change that took place in that vote the other day, and some people were prepared and some weren't prepared. But I think the most important thing is whoever had been elected, and this is my belief, they are entering and can be responsible for the most complicated geopolitical, military, and geoeconomic situation that the world has faced since World War II. And of course, I wish them all the best. I think people try to help get through this. It could be a difficult thing with a lot of unknowns and uncertainties. And so policy is going to matter. And, of course, who runs the government will be determinative there.
President-elect Donald Trump sends a message to you that he respects you greatly, but you will not be part of the Trump administration as a Treasury Secretary, if that were something that were interesting to you.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. And I'm not about ready to start.
I want to start by also talking about the response in markets in the U.S., which has very much been, this is going to be a pro-growth shock with companies that are going to be investing much more, deploying cash, aggressive in terms of U.S. expansion. Have you seen any signs that that's truly the case?
Well, yeah, you've already seen, the markets have responded quite well. And, I think America needs a growth strategy, so I literally applaud that. I think collaboration between government and business is the way to have growth. They've already spoken about a deregulatory environment. What I want to point out, I'm not talking about just getting rid of regulations, but the regulatory environment in most countries has become stifling. And in a lot of countries, including Peru, it's why you're growing maybe at 2.5%, not 4 or 5. In America, it's why we've been growing at 2% for 20 years and maybe not 3. So I do think it's a reasonable thing to have that kind of reform. And that reform has to go deeper than just regulations, which can unleash capital and investment and banking and stuff like that. It's got to be permitting and all the related things that come with that, where people, you would just mention me a mine that, someone bought that could do rare earths in the United States. It's 10 years, they haven't gotten their permits yet. I mean, it's a shame, and we're doing this to ourselves, and it's a mistake. So I applaud any government that says, I'm going to make government more efficient. And I think inefficient government is one of the reasons that people are frustrated. That why you have some populism, because they may blame, they may look at big companies, but they also know their government isn't spending their money wisely.
JPMorgan CEO Jamie Dimon speaking with Bloomberg's Elisa Abramowitz at the APEC CEO Summit in Peru. Let's take a quick check at where markets are before the trading day later today. If we take a look there, a bit of red, quite a bit of red, as we can see for U.S. equities. S&P futures down just about 0.2%. NASDAQ futures about 0.4%. A lot of this downside does follow those comments that we got from Jerome Powell on Thursday, suggesting a more cautious approach to rate cuts, potentially that having an effect elsewhere. Asian markets also slightly firmer today. We see the yield there slightly up 4.4610 for the 10-year yield. And we're also seeing Brent having an impact as well. There's a stronger dollar affecting Brent crude down 0.8%, and WTI about 0.8% as well. Stick with us. More coming up next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. The IEA says global oil markets face a surplus of more than 1 million barrels a day next year as Chinese demand continues to falter. S&P Global Ratings fears deadly protests in Mozambique could push the nation closer to debt default. And hypermarket chain Lulu disappoints after its mega UAE IPO debut, marking the second muted large Middle Eastern listing in recent weeks. It has just gone at 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg. Welcome to the second hour of Horizons Middle East and Africa. And quite a week it has been for markets, as we can see if we take a look at where they're positioned ahead of the trading day. Let's just start with Asian equities, though. Modestly firmer today, as you can see, they're up almost 0.5%. We got consumer retail sales data out of China that actually beat expectations, giving a slight boost to Chinese stocks. We are awaiting Alibaba results, potentially adding more fuel to that. U.S. equities, though, they're losing a bit of steam from that post-election rally that we had been seeing. S&P futures, as you can see there, dipping below that 6,000 print, down about 0.3%. And we're also paying close attention to what is happening with the dollar-yen cross right now, 156.38. We did get comments from the finance minister pushing back ever so slightly, and we're waiting for Governor Ueda's scheduled press conference that could potentially affect what we see with the dollar-yen cross, though a guest that we had earlier today does not expect that we'll see prices continuing to increase. She thinks potentially it will moderate just around here. The 10-year yield also up about 4.4591 right there. And of course, a lot of this reaction in the markets is because of what we did hear from Fed Chair Jerome Powell on Thursday. If you take a look at this terminal chart, that illustrates potentially what the market is expecting now, paring back on expectations of cuts, especially now that Fed Chair Jerome Powell says potentially cautious approach is what they are looking for. The market now pricing less than 25 basis points of cuts across the next two meetings. Potentially that means we see a cut in December, a pause thereafter. But really, a lot of these comments from Fed Chair Powell and the Fed speakers that we had this week having an effect on markets globally. And let's just stick with that and the effects that we are seeing globally. Right now, we are joined by Chiedza Madzima. She is the head of global operational risk research at BMI, a Fitch Solutions company, here in Johannesburg with me. It's a pleasure to have you on, Chiedza. So over the past few days, we have seen EM assets reacting to what is happening in the U.S., as they typically do. I wonder, how are you interpreting the moves that we've seen over the past few days?
Yeah, so there's essentially two elements to this. Of course, there's the Fed's or prospects of the Fed's less aggressive cutting cycle. And of course, this will affect monetary policy, especially across the region. When you look at the likes of South Africa, we'll likely see a slowdown in the pace of cuts in the years through to in the quarters through to 2025. But I think more broadly, when you look at the impact of the incoming administration, the incoming Trump administration, we will likely see a geostrategic pivot and sort of areas of new engagement with certain markets. So a stronger focus on bilateral agreements, a stronger focus on driving private investment across the region. So, the sort of key markets that stand out to us are the likes of Kenya, Morocco, that already has a standing FTA with the United States, as well as Angola, that'll benefit from investment when you look at the Lobito corridor. But more broadly across the region, I think in light of the potential changes that we'll see in terms of U.S. fiscal policy, in terms of trade policy, we could see global risk aversion continue to rise. And of course, financial conditions remain tighter for longer. And this will add pressure on emerging market currencies, on SSA currencies, risk assets. And I think South Africa, given that it's a widely traded currency, is particularly exposed to that trend of global risk aversion and, of course, a strong dollar.
So we've talked a lot, Chiedza, about the usual suspects, I guess, that could be the recipient of some of these increased trade tariffs. That's China, potentially that's Europe. When we think about EMs, you mentioned potentially risk off will increase. What are we not factoring in at this point? What are you paying attention to that could see some effects of an increased America First policy?
Well, again, there's two sides to this coin. So with an increased America First policy, of course, the prospects of more hawkishness towards the likes of China, we'll certainly see the Trump administration look to bring a lot of manufacturing back to the United States. But this also presents opportunities for other emerging markets around the world, including Africa, to start moving up the value chain and also stepping into those pockets of opportunities when it comes to the broader supply chain reconfiguration that we'll likely see. So, of course, the likes of your Egypt, Morocco, South Africa, Kenya really stand out in terms of filling in those supply chain gaps. But that is contingent on these markets also implementing the necessary pro-business reforms that will then attract that kind of investment. On the downside, if you look at trade across the region, just Asia and Europe alone, just those two collectively account for about 70% of Africa's exports, and China is a big factor here. So any slowdown in China's growth and, of course, potential trade barriers on China will have a large sort of second-order impact on Africa's exports as well, especially when you look at the sort of minerals sector.
What does that mean for your growth outlook expectations for sub-Saharan African economies?
It's quite mixed, but broadly we're more positive on the region's prospects over the coming 5 years, especially to 2030. We're looking at around a 3.9% clip on average for the region. Of course, the key bright spots will be in East and Central Africa, as well as parts of West Africa. When you look at Cote d'Ivoire, the likes of Senegal, that will see growth above that 5% mark. Southern Africa, on the other hand, will likely register the slowest growth. South Africa, being the largest economy in the sub-region, will be a particular drag, but prospects are brightening slowly in the coming years. And I just want to highlight that we are particularly bullish on the export growth potential for markets like the DRC, like Zambia, like Tanzania, given their potential in terms of exporting new energy minerals or green transition minerals, which will be a particular area of focus for Europe as well as, sort of North America and Asia, to be honest.
But you still see South Africa as being a drag to Southern Africa, even despite some of the reforms that we've seen, investors more bullish on the economy. I mean, why is this still a sticking point for you?
A lot of the problems are structural. So for this year, we forecast South Africa to see, or rather eke out a 1% growth clip. It'll trend upwards to around 1.5% next year, 1.7% the year after. And yes, we are positive on loosening financial conditions that has a follow-through impact on private consumption. There is market optimism around the new government formation and some of the areas of reform that we're seeing, especially around state-owned enterprises and a push towards fiscal consolidation. But there are considerable internal challenges when you look at transport inefficiency. There are still quite considerable challenges there. In the energy sector, yes, the electricity reliability has improved, but there are gas sector risks that we're looking at beyond 2027. And, of course, the structural drag of high unemployment within South Africa.
It's north of, it's north of 20%. I mean, and there's still some issues there in terms of finding these actual jobs for young people, right?
Yes. So the latest print actually came in at 32.1%. And if you look at the expanded definition, that's above 40%. Youth unemployment, again, slightly above 43%. And yes, this is the lowest unemployment figure we've seen in a year. However, if you look at the numbers, if you look under the hood of these numbers, at the sort of volumes or the numbers of the employment figures, it's quite apparent that a lot of the growth that we've seen in employment over the past year largely came from the informal sector. So we haven't really seen much movement in formal sector employment, and this kind of speaks to the need for a faster pace of implementing reforms, especially when it comes to labor market regulations that remain quite rigid, even in comparison to other emerging markets, implementing reforms to boost sustainable transport and, of course, energy sector logistics, and improve the security environment. These are key areas that investors are looking at moving forward.
Yeah, and potentially looking to other markets, though, as we await some of these changes. We're going to leave it there. Really appreciate your insights. Chiedza Madzima, Head of Global Operational Risk Research at BMI, a Fitch Solutions company. Thank you so much. Now, let's stick on oil. The IEA says global oil markets face a surplus of more than 1 million barrels a day next year as Chinese demand continues to falter, cushioning prices against turmoil in the Middle East and beyond. Let's get more from Bloomberg's Dan Murtaugh. So, Dan, is the focus really China? I mean, what do you believe is driving the price action when it comes to oil right now?
Yeah, if you look at the oil market, in a normal situation, you have war in the Middle East, you have OPEC pulling back large amounts of production from the market. That should be really bullish, but the oil just cannot get any positive momentum, and that's all because of China. It's the world's largest oil importer. The economy here has been pretty weak for years now, and so that's definitely a drag on it. But the focus is shifting less on the economic part of it and more toward the long-term energy transition here. EV sales have topped more than 50% of all car sales for the last several months, and when you talk to people on the street, it's just you think it's got nowhere to go but up. That's really starting to dent into gasoline demand, and unlike somewhere like America or Europe, where when gasoline demand peaked, there was a kind of long plateau. Here, because we're going from cars or ICE cars to EVs, that's going to be a really sharp decline. And so without China as a driving force for global oil demand growth, you're really going to see it's going to be tough for all these suppliers out there, these new supplies coming on from the U.S., from Brazil, from Guyana, as well as the supplies that OPEC wants to bring to the market. It's going to be tough for them to find buyers. And so that's why you're seeing a real struggle for any kind of sustained price momentum in the market this year.
And Dan, not to mention, I speak with quite a few African producers that are trying to get into the market as well. What's interesting here, too, Dan, we were speaking with a guest earlier who says that the market is overly bearish, though, on what we are seeing with oil prices, and she doesn't expect it to continue to be as volatile as it is. Is that your expectation? I mean, could we see a Trump presidency having an even greater effect than we're factoring in, or than the markets are factoring in right now?
Yeah, I mean, one thing we've already seen is, this Trump presidency, there's been a lot of dollar strength, which makes oil more expensive in emerging markets, and that's going to put a little extra downward pressure on prices. But, I mean, it's a big uncertainty. What happens if Trump puts big brakes on trade? That's gonna drive down oil demand, and it could make things even more bearish. But alternatively, Trump might have side effects we can't even imagine right now on geopolitical tensions around the world, which could release supplies, which could further constrain supplies. I think it's tough to read too much into what a Trump presidency might mean outside of the idea that if there's going to continue to be a strong dollar, that's going to continue to be a drag on the oil price in general.
Yeah, we'll leave it there. Brent Crude there. Over the past few days, we were just taking a look at that chart. Bloomberg's Dan Murtaugh. Dan, thanks so much for your insights. Thanks so much. Now, coming up, deadly protests in Mozambique are pushing the nation closer to debt default, says global ratings agency S&P. More on the unfolding economic turmoil next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, S&P Global Ratings says deadly protests in Mozambique are increasing the risk of a domestic debt default. For more on this, let's bring in Bloomberg's Ndiro Aganga, who is joining us from Kigali. So, Ndiro, what are the leading indicators pointing to the probability of a default? What is it that S&P is looking into?
Jen, so Mozambique was locked out of the international markets in 2016 and has had to heavily rely on the local market to finance its budget deficit that S&P estimates to average about 4.3%, leading all the way to 2027. They've also had to heavily tap into central bank financing, and their analysts say that unless there's a sharp fiscal adjustment or windfall, then the country could be heading towards restructuring or delay of payments. And just for context, their local debt has doubled since 2020 after they finished restructuring their Eurobond, and the government recently offered lenders a new bond with longer maturities, pointing to liquidity challenges. We could also be looking at a solvency crisis in the near future because incoming maturities are significantly large. If we look at their currency, it has maintained some form of stability, but there are huge backlogs in October of about $440 million, and the wait period is about 3 months. The government can't do much about the currency. They're tight for cash. They can't prop it up, and they also can't devalue it because there's that risk of inflation.
When we look at what we've seen post-election, Ndiro, how significant has this been, not just for the economy there in Mozambique, but really regionally, because we have seen other states and nations have to respond as a result?
Absolutely, Jen. It has had quite an impact. If we just start with the economy that you mentioned, the biggest business association in Mozambique is estimating that they've lost nearly $390 million, which is equivalent to about 2.2% of GDP. Then in terms of relations with neighbors, the border with South Africa is really, really important. And the government estimates that due to that closure, they've lost about $6 million. South Africa exports its ferrochrome through Maputo, and that closure has affected the movement of these goods and also people in and out of Mozambique. You also have the government also estimating that there could be delays in their $20 million project of natural gas with Total Energy. So these are just some of the economic effects that we are likely to see. When it comes to pressure from this protest, it's in the fourth wave, and the opposition leader Mondlane is saying that they want to keep applying economic pressure where it will hurt the government. He called for his supporters to paralyze major trading routes, asking truck drivers to actually stay at home. And they're hoping that this applies pressure on the government. The government is already struggling financially because it has spent a lot of its money in fighting insurgencies in Cabo Delgado.
And then, Ndiro, I mean, are we hearing much from the ruling party? You mentioned there that what the opposition candidate has been calling for. He's really, on many accounts, the one who initially called for this unrest to start. What are we hearing from the government then?
Jen, those headlines could begin softening soon because a lot of international pressure and regional pressure is beginning to be applied into the country. You have neighboring leaders, including the SADC bloc, calling for dialogue, calling for truce, calling for negotiations. So this is the direction that we are likely to take. These protests have been very deadly. They've left nearly 40 people dead. And this has also attracted concerns from international bodies, pointing a finger of blame at the government for using excess force. We are not likely to see the opposition recede their ground. We've had Mondlane say that parallel tally show that he won the elections by 53% as opposed to the 20% that was allocated to him. And he has quite some form of demands. He wants to be declared the winner. He wants the government to build 3 million houses for the youth over a period of 5 years. And this is not feasible. So out of the SADC negotiations, we are likely to see what comes out of it, but they're pushing for dialogue.
Yeah, and of course, this heading into a very busy season for the economy and for tourism there in Mozambique. So important to note some of those indicators you were mentioning. Bloomberg's Andiro Ganga. Andiro, thanks so much, as always, for joining us. Now, coming up, a disappointing debut. Shares in Lulu close flat following the Middle Eastern hypermarket chain's mega IPO. We have the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. To the Middle East, where Lulu shares closed flat after its $1.72 billion IPO in Abu Dhabi, marking the second instance of a muted debut for a large Middle Eastern listing in recent weeks. For more on this, let's bring in Bloomberg's Middle East Equity Capital Markets reporter, Laura Gardner-Cuesta, who's joining us from Dubai. So, Laura, what happened here? Why did we see such a muted debut after all of the hype?
Yeah, thank you so much, Jennifer. As you said, it was the largest UAE IPO this year, and it was upsized from 1.4 to 1.7 billion. It drew in a massive order book of $37 billion, and investors from sovereign wealth funds in the region to Vanguard internationally. So on the face of it, we were expecting a strong debut, but like you said, the shares traded flat yesterday. And I think there's a couple of things here. Firstly, these large order books that we see in the region are often the result of investors simply not getting the allocations that they would like, and this leads them to put in significantly larger orders. This doesn't necessarily translate to strong secondary performance. And on another point that some investors have pointed to is that the valuation was already pretty full. So they priced at the top of the range, they upsized the deal. So perhaps it was a case of not leaving enough on the table for investors. And this could also explain the muted performance yesterday.
Could we potentially see a turnaround though, Laura?
Yeah, so I think we shouldn't overplay this. Essentially, investors are still very confident in the company. They know that it's a strong household name in the region. It was founded by an Indian expat in the 1970s, or rather, the Indian. It was founded by an Indian businessman who moved to the UAE in the 1970s and has grown the company into one of the largest retailers in the Middle East. So still very much a strong company. And I think what investors will be watching for is whether they can deliver on the expansion plans that they have laid out. They've guided pretty aggressive net profit margin growth, and this is something that I think investors will be watching over the next few quarters, see if they can deliver.
Laura, could this potentially have any sort of impact on other IPOs that we see in the region, or is this a one-off that we should take just given the description that you're describing about this particular company?
So I guess we'll have to see. This was a rare private sector listing in the region. We have another one coming up in the form of Talabat, so it'll be interesting to see how that one does. I think it will come down to valuation as well, and we'll have to see whether they can entice investors. It's also quite late in the year. Some investors might be thinking it's time to sit back, and so there will have to be a very enticing proposition for Talabat, I think. We'll see.
Fascinating. Bloomberg's Laura Gardner-Cuesta there in Dubai for us. Laura, thanks so much. Thanks for your reporting and for joining us. Now, a quick check at where markets are positioned ahead of the trading day. If we take a look at futures, we are seeing equities broadly taking a bit of a breather since we saw that post-election rally. S&P futures below that 6,000 print. Also, NASDAQ 100 futures down about 0.5%. The Europe trading day is starting slightly in the red right now, but potentially we'll see whether or not we have some other indicators that we get throughout the day that could change the direction of travel for them. That's Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe. This is Bloomberg.